guys, so the second conversation that we're going to have today on, Your Money Matters is with regards to your investments, right? As you step into 2026, it's very important to understand what are the different cycles in which, markets run, how, how this shapes up your entire portfolio. And to discuss exactly this, we're joined by Nimesh Chandan, who's the Chief Investment Officer at Bajaj Finserv AMC, joining us now. Nimesh, festive season greetings to you, and thank you so much for taking out the time and speaking with us at NDTV Profit. My first question to you is that, generally when you track markets, you track it in 4 different cycles, right? There is economic, profit, credit, and sentiment. Why is this lens especially useful now? Because we've seen last 1 year of consolidation, and how, analyzing all of these 4 will be important stepping into 2026.
Hi, Mahima, and season's greetings to you, to viewers, and your family and friends. When we actually analyze markets over a longer term, these are the 4 cycles that actually create an impact and lead to the market moving, either rallying or falling, so moving in either direction. The economic cycle and the business cycles are slightly more longer term. The credit and the sentiment cycle can move very quickly or turn very quickly. This year, what we have seen in 2025, we've seen improvement in economic growth. Inflation has been under control. Interest rates have been cut. Income tax as well as GST tax have been cut. So there is an uptick in the economic cycle. We are seeing aggregate demand moving up, and so economy is doing well. And second half will show much of that in the results also. The second cycle then is the business cycle. How is the business doing? And businesses are measured by how their profits are growing.
Correct.
So if you take Nifty 50 companies, last year we were seeing downgrades in earnings. This year we've started seeing some upgrades, and second half will see a good push upward. And we have seen a lot of upgrades coming for FY27 and 28. So even the profit cycle, the business cycle is turning up.
Okay.
Credit cycle is where liquidity, financing is available. So we've seen after interest rate cuts, OMO, CRR cut by the banks, we've seen a pickup even in the credit cycle in the country. The cycle which is left to turn upwards is the sentiment cycle. And this is where people are anxious, people are worried about trade deals, about tariffs, about depreciating rupee, balance of payments. These are the issues which are actually pushing the sentiment lower. To wait for that revival. And I believe maybe stepping into next year, if we have a deal with the European Union and the US, we will see even that sentiment recover. And hence, we will see a strong up move then in equity markets.
Okay, understood. Nimesh, the other aspect is that, all the factors that you mentioned with regards to economic cycle in India, which according to you is on an uptrend and which is being seen, right? Do you think that despite of, the kind of trade deal not happening, that's probably the only factor which is probably, the reason why FI is also staying away from Indian equities right now. But do you think that this uptrend is enough to sustain at least some kind of rally that we'll see in 2026 if the trade deal doesn't happen?
Actually, that's a very interesting question. The trade deal is very important for the sentiment, may not be really that important for economic and the business cycle. And I'll tell you why. The total GDP impact of US tariffs on us and resultant slowdown in exports is 0.3 to 0.5%. We've seen much bigger stimulus coming in fiscal and monetary side for the country to compensate for that. If you look at the profit pool, in the BSE 500 or NSE 500 companies, less than 2% of the profits are affected because of the US tariff.
Okay.
So, if you look at numbers, it is not impacting much, but sentiment has definitely got a bit dampened because of this. During these times, people give very high weightage to uncertainty. Even if there is no risk, they give weightage to uncertainty, and the way they show their concerns are by reducing the valuation of a stock or a company or a country. When these trade deals then get signed, the same gets re-rated upward. so that those dark clouds move away and the sentiment is positive. So we see a re-rating that way. So I would say, despite, I mean, whatever tariffs that we are having, the economy is on a strong footing. Probably more measures expected from the government side, especially export sectors. But sentiment is looking at these trade deals and somehow anchored on those.
Okay. From here on, Nimesh, do you think that the earnings cycle will be more focused towards your profitability expansion, margin expansion, or would it be more focused on volume growth? Now, this might not be, I mean, this answer cannot be a broad base, one might be sector specific as well.
So actually, you're right. So it has to be a mixed answer. In
Yeah.
some sectors, we are seeing pickup in, so domestic sectors, for example, we are seeing pickup in demand. And the commodity prices are still quite benign, especially on the soft commodity side, which is why many of these consumer companies will also see expansion in terms of margins. So domestic companies, domestic oriented companies are likely to see pickup in volumes and benefits of economies of scale coming in and lower commodity prices, which will help them expand margins, and we'll see earnings growth being higher than the top line growth, but a healthy top line growth. On other sectors, for example, pharmaceuticals was never impacted so much by tariffs and even the domestic economic cycle. So they continue on a steady path of revenue growth, and possibly the similar margins that they have, they go with that. In some companies, we may see some slowdown in the top line where, say, IT sector is concerned. This is where we see some kind of slowdown coming in terms of the revenue growth. The rupee may help their profits or margins for some time, but then when people give a rating to a company, they may not just give a higher rating because of the rupee benefit, because ultimately it gets passed on. So different sectors will have a different color in terms of combination of top line and bottom line growth. But overall, from what the estimates are from analysts, next year looks like a mid-teens kind of a earnings growth for Nifty companies.
Okay, understood. We did talk about how the credit cycle is improving, right? The government has also done a lot in terms of boosting the liquidity. Just want to understand that this credit upturn, do you think that this will actually lead to real private capex revival? One thing, because right now the kind of a difference between demand and supply in that space is really tight, right? And any kind of uptick in the private capex revival is going to solve that and is going to bring down the prices. So what's the view there?
Again, if you see, private capex happens when animal spirits are high in the country.
Yes.
Businesses see very good visibility of demand, they see higher capacity utilization in their factories or their plants, and then they plan for future. That sentiment will turn slowly. I don't think we see immediately private capex coming in, but say by second half of next year, we will see that because of the pickup in demand, the capacity utilization is moving up, and the steps taken by the government and the RBI actually set a good foundation for it, I would say. So they don't immediately impact that just because of interest rates are down, a company will do higher capex. A lot of projects become viable, and maybe with the fiscal policy and the demand going up, many of these projects become more interesting for companies. So it kind of sets the base, but once companies see the demand coming, visibility of the demand growing, and visibility of capacity expansion, capacity utilization, they will go into expansion mode.
Okay, understood. Nimesh, how should an investor think of valuations considering the cycles, at least 3 of the cycles looking favorable?
So that's the thing. When sentiments are low and fundamentals are improving, that's an opportunity to invest in the market.
Correct.
Here we have to actually look at the growth and value kind of equations within different sectors and within different market cap categories also, whether it is large cap, mid cap, and small cap. We find valuations very attractive in large caps. On the other side, in small caps, it's difficult to generalize on valuations, but at least today, we are seeing a lot of opportunities within small caps where stocks have corrected, say, 30% from their highs or 40% from their highs. Many of these companies, not all, but many of these companies, which are going through temporary down cycle or have temporary worries and good businesses, those can be picked up. On the mid-cap side, the universe is a little small at 150 companies, but we've seen valuations being generally higher for mid-caps compared to both large caps and small caps. So here we have to be even more selective when we are investing in mid-caps.
Okay, Nimesh, if the sentiment is the final lever, right, for the entire markets to pick up, how should investors position themselves right now?
So it is important that you stick to one, your asset allocation discipline, and whether you're doing an SIP or STP, you stick to those disciplines. This is a good time to accumulate or increase investments on the equity side. I know a lot of people are very excited about gold, silver, and the other assets which are rallying.
Correct.
But equity, after the year of kind of time correction we have gone through and the earnings upgrades we've seen, equities are attractive. Be very selective about the portfolios that you're picking up. I gave a general color of the sectors and where we see opportunities. So we see opportunities in the domestic market, in consumption, in financial services. Healthcare is kind of a strong growth area without impacted by, I mean, not impacted by export tariffs. And IT, we are a bit cautious. So this is the kind of lay of the land as what we see. But within large caps and selective small caps, also as categories, there are opportunities to pick up or increase your allocation towards equities.
All right, understood. Nimesh, lovely chatting with you, and I'm sure that our viewers who are watching this have a lot of takeaways from this conversation. So thank you so much for taking out the time and getting us throughout the show.
Pleasure being on your show, Mahima.
All right, so we talked about your portfolio, your tax, but IPOs has been, the talk of the center in 2024 as well as in 2025, both blockbuster years for IPOs. How it's shaped up in the past 2 years and what it is looking like in 2026 is exactly what we've tried to break down here. What sectors did IPOs come in, how subscription looked like, how listing looked like. Listen into that link that we did for you. Yet another blockbuster year for IPOs, 2025. 2024 also was a big year for IPOs. Just to give viewers a perspective, the total fundraise that IPOs did in 2025 was 1.95 lakh crore, around 365 new IPOs. For 2024, that was around 1.9 lakh crore with around 336 number of IPOs. So total around 3.8 lakh crore has been raised in the past 2 years with around 701 IPOs. And this is much higher than what India did in just 5 years before that, between 2019 to 2023, of around 3.2 lakh crores. Moving on to the main board dominance, of course, 106 issues were raised in 2025 of around 1.83 lakh crore out of that 1.95 lakh crore. The landmark IPO, of course, was Tata Capital, which was the 4th biggest IPO, which raised, around 15,500 crores in October 2025. With regards to where the sectoral trend stands for 2025, slightly different from where it stood in 2024. NBFCs dominated with 26.6% of the total IPO being NBFCs, followed by capital goods and technology at 9% and healthcare and consumer durable at 6% each. Now the shift that we saw in terms of sectoral trend versus 2024 was that 2024 was led by automobiles, telecom, retail and private banking rather than NBFCs and consumer durables. Now in terms of subscription numbers, strong subscription was seen in terms of DIs, your FIs, even in terms of your retail investors. IPOs oversubscribed around 26.6 times on an average over the last 2 years. In terms of the overall listing, there has been difference in terms of where the subscription numbers stood, whether the stock got listed on a premium or discount, but the listing shenanigans were slightly different. Out of the 197 main board IPOs in the past 2 years, 108 are trading at a premium of over their offer price. So that accounts for around 55% of the total IPOs that got listed in the last 2 years, and 14 are trading at a premium exceeding 100%. In terms of QIPs also, not just IPOs, QIPs also did raise a lot of money. Around 2.1 lakh crore was raised via 134 QIPs. SBI alone contributed around 35% in terms of total QIPs. And sectors that raised QIPs largely included PSU banks, e-commerce, capital goods, NBFCs and healthcare segment. Lastly, in terms of what MOSL has to say with regards to IPOs to come in 2026, well, they believe that this momentum is going to sustain and here to stay. It will be supported by strong domestic institutional flows. And in terms of emerging listing themes that are expected in 2026, that includes renewable energy, quick commerce, as well as something like an app-based business model. So this is everything that has gone so far in 2024 and 2025 and what you can expect in terms of IPOs in 2026. All right, viewers, with that, we're completely out of time on this edition of Your Money Matters. Stay tuned, more news and updates on the other side.